Hi, Michael Glennon from Glennon Capital, and today I'm going to talk to you about buying undervalued businesses. So there's a saying in the market, cheap not good, good not cheap. So what that means is, quite often good businesses are not cheap, and quite often cheap businesses stay cheap, and there's a reason for that because they're not a great business. So when you're looking at value, very important to be able to say, look, what am I buying? What value do I think I'm getting? And it's no different to buying a car or a house. You have to perceive at some point in time that you think that that investment is going to be worth more. If everything that's going to go on in the future is fully reflected in the price now, there's not a lot of value and you're not going to make a lot of return out of the share price. So, much of this stuff sounds obvious, but for us to be able to assess what value there is in a business, there's quite a fair bit of work that we have to do to be able to determine that. So one of the things we look at is we look at this future stream of cash that's going to come into the business, and we have to make certain assumptions about that, which reflects the quality of management, the industry that the company operates in, the sustainability of the business and the earnings, their ability to put up prices, margins, and competitive threats. So when we model out a business and we look at the cash flows that are coming back into the business, we will come up with a valuation of what we think that business is worth today. And if it's all reflected in the share price, everything that we think is going to happen in the future, there's no value there, so we stay away from that business. We do monitor a lot of businesses that are trading in the market at expensive prices that we can't justify, but there might be times where there's volatility, nothing's happened in the market, it might have been some short-term noise that's affected the share price, and that provides a good opportunity for us to enter into that position because we can see that the valuation gap has increased from the intrinsic value, what we think it's going to be worth in a few years, to what it's currently trading at now. So buying undervalued businesses is the key. There's many good businesses out there, but you need to know what that business is worth, and it takes a little bit of time and skill to be able to assess what you think a business is worth now and where you think it can be in a few years' time. So we talk about some of the things that we look for in businesses. We need to encompass all of those things, like quality of management. Can they deliver on the plan to grow the business? Is it cheap now? It might be trading on a very big multiple now, but we can see that in a few years' time, that business will be significantly bigger or making more money. And when I say undervalued, it really needs to be reflected on a fundamental valuation based off the cash that's in the business, the cash that's being generated, and what's actually being generated per share and returned to shareholders in the form of either EPS or dividends, ultimately, for a business that's got a lower growth profile. So that's what we mean by buying undervalued businesses. It's very important. You need to always be looking at value and what you're getting for what you're buying. Thanks for watching. If you've got any questions, please feel free to ask. Thank you.